I think for better or worse, there are some habits that are quite ingrained in us, like asking for an extra papdi at the Golgappa stall, extra dhania, extra mirchi at the vegetable shop, or extra packets of oregano and seasoning from the pizza delivery boy. सबको extra चाहिए और वो भी free. And therefore, in this free video, I'll be taking you through 5 different ways using which you can make some extra returns on your equity mutual fund investments. I think it's an important topic because although a decent portion of our wealth is managed by others via mutual funds, ULIPs, and NPS accounts, we still have the flexibility to do something with it that can improve our portfolio's overall returns. As always, I'll be working on historical data, and please don't ask me in the comments if this will work in the future or not. I don't know that. Also, we won't be talking about basic stuff like direct versus regular or small cap versus large cap. I think there is enough information on this, and we all understand that different fund categories have performed differently over the last 3, 5, 10 years, and every category has taken a meandering course to reach where they are. And finally, I've borrowed some of the material we'll be discussing in this video from other videos, including my own. So while this might feel like a compilation, if you want a more detailed explanation, then please access the links that are available in this video's description. With that being said, and because we have a lot to cover, let's begin. The first technique to gain some extra mileage from mutual funds is something we discussed in the very first video on my channel. This one was specific to small cap funds, and using the Nifty 50 as the pivot, we were able to frame the ideal buy and sell periods for the Nifty Small Cap 250 index. Now, interestingly, a similar relative comparison can be done for the mid cap index as well. And this time, instead of downloading the data and putting it in a worksheet, I chose to do this using visual clues. So on TradingView, I found this functionality that allows us to divide one index by the other. So something like a relative index, which I then use to create a buy-sell zone for myself based on simple observation without needing to resort to any mathematical formula. Now, as a simulation, and because many of us use the SIP mode of investment, I translated these 3 sections into 3 action points. That is, I either continue the SIP, or else I pause the SIP, or thirdly, when the relative index is in the bottom third, then I double the SIP amount. When I tried it over the last 13 years, so from October of 2010 until September of this year, this particular scenario would have given me a higher corpus at a lower capital as compared to a regular SIP, which on an XIRR basis translates to an extra 0.5%. Now remember, this 0.5% is not a firm rule, and depending on what level you keep for buying, selling or pausing, or when you do the calculations etc., this number will definitely change. But thankfully, every time I've tried this, I've always managed to receive that extra 0.5% to 1% jump in returns. And this is SIP, right? So if I were to do it on a lump sum basis, that is, you go big when the buying zone shows up and you redeem during the selling phase, well, in that scenario, your net gain can be a lot higher. So test this out, use this more as a trend, and of course, enjoy that extra 0.51%, which can amount to quite a bit over the long run. As a part of our evolution, we humans have always possessed an innate ability to recognize and evaluate risks. It is this awareness of potential dangers that has helped us make informed decisions and has ensured our survival over many thousands of years. Now, when I connect this to the financial markets, in an ideal world, it should not be difficult for us to recognize when the stock markets are at an extremely risky level. I mean, think of periods like the year 1997 with the Asian financial crisis, the year 2000 with the dot-com bubble, 2008, 2011, 2015 to some extent, 2018 for mid-cap and small caps, and even now it seems the mid-cap and small-cap temperature is on the higher side. My point is, if we can avoid participating in the markets during these high-risk periods, then what was originally a return expectation of 12 to 14% can easily go up by another 3, 4, even 5% over the long term. Which brings me to the point, how do we recognize these periods of high risk? And I want to share with you a few simple indicators here. The first is what is called a parabolic rally, which is something that happens towards the end of a bull market where everything goes up by 30, 35, 40% over a very short period of time. For example, while the Nifty peaked at 6,200 in December of 2007, until 4 months back, that is until August of that very same year, the Nifty was at just 4,190 points, which means the Nifty had jumped by 49% in a matter of 4 months, which is a clear telltale that the market is extremely overheated and something bad is going to happen. We saw a similar thing in China when the markets there went up by 136% in a matter of 8 months, and more recently with the Nasdaq 100, which after having doubled over 2 years went up by a further 30% over a 5 to 6 month period. A second indicator to look for is the market cap to GDP ratio. From an Indian context, this number ranges between 50 and 100. And as a thumb rule, if the market cap to GDP ratio is below 60%, then it's time to get aggressive. And if this number were to go above 90%, then it's better to be cautious with your equity investments. A third indicator, and something that people who are into technical analysis generally look for, is the market breadth. The term market breadth refers to the overall health of the market, and this is done by comparing the number of stocks that are advancing versus the ones that are declining. So if a limited number of stocks are going up while the others are down, then it shows a narrowing of the market's breadth, which means there is weakness in the market and probably a big correction is on its way. Okay, so I've covered 3 indicators here, but there are a few more, and if you're interested, then look at the VIX or the volatility index, and if the number is high, then one should wait for it to cool down. Another interesting indicator is Google Trends, which gives us what people are searching for. And if there is heightened interest in a topic like penny stocks, for example, then you definitely know that the market is definitely heating up. Yet another method of identifying speculation in the market is to check the F&O turnover. And if this number is on the rise, then please be a little cautious about entering the market. Right, so these are some popular techniques we all can use, and believe me, it's in our interest as investors to pay attention to these metrics and to use them both ways. That is, to be aggressive when the odds are in your favor and to be cautious when things are not going in the right direction. In fact, one of the questions you might have is, should I be switching completely from equity to debt during such situations? And in my opinion, you don't need to go all in, and what you can start doing is to move from, say, an 80% equity to a 70% level. And if the situation persists, then you can move to 60% and so on. You'll have to use your own judgment on this, but to quote Mark Minervini, the key to super performance is to lose the least amount when you are wrong. But what if there is something where you have nothing to lose and you can't be wrong? Because the Fisdom Academy now features a foundational course on the basics of stock markets, which is available to you absolutely free of cost. Free! Conceived and presented by Nath Thakkar, who heads Fisdom Academy, this course gives you a strong foundation on the functioning of capital markets, why and how shares are issued, how to start one's investing journey, before Nath rounds it up with a section on how one can select stocks for investing. It's very much a course for beginners and one that promises to give you the right knowledge when you first start out with equities. So have a look at it, and if you love it, don't forget to leave an appreciation note for the hard-working team at Fisdom Academy. As always, the link to this free course is available in this video's description. The third strategy in our list is to buy the dip, and as an approach, it involves the purchase of securities whose price has experienced a temporary decline or a dip within an overall upward trending market. So there are two things here. One, we are looking for situations where the stock price or the value of the index has declined, and while there is no consensus, generally it means a 15 to 20% reduction. And secondly, this dip should have come within an overall upward trending market. So essentially and visually, it means the instrument per se is probably a nice big rising wave, and we are trying to take advantage of some smaller blips in the middle. For instance, the 200 DMA, and please recall we discussed this in my video on moving averages. So the 200 DMA is an effective tool in not only determining the optimal points of investing your lump sum money, but a widening of the price gap to say 17, 18, 20% is an indication that the markets are expensive and it's time to head for the exit or at least avoid further investing. In addition to moving averages, a second indicator, and Kunal is just gearing to make some content on this. So a second indicator and a rather popular one is RSI or Relative Strength Index. Now I won't get into specifics here as there is definitely a video coming, but to put it simply, and I'm saying this keeping the long-term investor in mind, but RSI can be used to identify entry points, and generally this is when the RSI is below 30. On the flip side, it can also help us with risk management, and when the RSI goes above 70, then it's generally an indication that a correction is due. And much like moving averages, long-term investors can use divergence analysis on RSI to spot a weakening trend and consequently a potential exit. So this is something new because for a majority of investors, a buying the dip strategy was always buy market 10% down है, चल कुछ खरीद लेते हैं. But what my research shows is that this strategy works better when a price decline is combined with an overall market trend, and I hope you now have a better appreciation of that. The fourth strategy is something we have discussed earlier in my Superman video, and like everything we have discussed so far, it tells us when is the time to be aggressive in the stock markets and when to be defensive, with the ultimate goal of eking out an extra 1, 2 or 3% in returns. This technique is built around the P ratio, which over long periods of time has turned out to be a reliable metric when looking at the broader markets. So I looked at 5 different scenarios in that video, which included a simple SIP investing strategy irrespective of the P multiple that delivered a 13% return. Then there was an approach wherein I ignore the expensive valuation month. That is, I invest only when the P ratio is 22 or lower, which gave me a CAGR of 13.2%. The third scenario is based on accelerated buying, where I invest regularly in all P bands. But when the ratio falls below 18, then I double down on my investments, which upped my returns to 13.6%. Then I received a 13.7% return when I started redeeming some money when the P ratio went above 22. And the fifth and final strategy is where I employed an accelerated buying and selling structure at different P bands, which gave me 14.7%. So 13% went up to 14.7%. And if you haven't watched that video, then I suggest you have a look at it and also explore the downloadable and customizable worksheet that's available in the video's description. But point blank, a little tweaking in the SIP strategy based on our understanding of P ratios does add a further 1 to 2% to our portfolio returns. Alright, the fifth and final return enhancement strategy revolves around factor investing. So a factor is defined as a specific characteristic or attribute that can deeply influence the performance and returns of a particular stock or portfolio. As it is the case, there are dozens and dozens of factors, but the more popular ones are around momentum, value, low volatility, and quality. And if you want more information on the same, then I already have a video on this topic, which I think is one of my better ones. Now, the part I want to focus on here are the returns, and what might come to you as a surprise is that when I did a comparison of some factor indices with the Nifty 50, the returns received from these factors were higher than what the Nifty 50 delivered in most years. I mean, look at this data from a ranking perspective and you'll see the Nifty 50 languishing at rank 4 or rank 5 in many years, which, if not anything, at least gives me a direction that one should start looking beyond market cap based portfolio development and should definitely give strategy based portfolio a definite try. Of course, please don't do a complete switch just because I said it, but maybe you can have a smaller portion, say 10-15% of your portfolio based on certain strategies. And to inspire you further, do have a look at this follow-up video where I used a combination of momentum-based factor index with a value-based one to receive a CAGR of 16.2% over these last 17 years. Alright, so these were 5 techniques. Actually, there were techniques inside techniques. So there's a lot of stuff I've covered on a broader basis. And if you want to take real advantage of these strategies, then please do watch some of my older videos. And I've added the links in this video's description for easy access. Also go through some other materials authored by other researchers and experts that I've again added to the description. And most importantly, please try out different variations of each method. And to help you out with this, most of the videos I've referenced would also have a worksheet attached to it, which you can download and customize as per your comfort. I sincerely hope you found this video useful and that you'll use some parts of it when you next review your own mutual fund portfolio. Please do like this video, do subscribe to my channel. This is surely one video that you want to share with others, and I'll see you 3 days from now. Until then.